What's up, Steve?
Not too much. How you doing, Adam?
Good.
Yeah,
Oh,
thanks for taking the time. As I was saying, it feels like it's been a while since we've done one of these together. So looking
it's nice.
forward to it. Thank everybody for turning out.
Yeah, nice to be here with everybody. Just say hello real quick. I like to get the screens moving and going. Put the comments on.
Get it lubricated. The conversation.
Steve, Tom said that his wife is happy that he listens to you. What should we call it? You guys all good? Say hello. Let's get. I like to see. I like to see. I like to see the crowd moving. It wakes me up a little bit. You could chat in the comments. There we go. All right. It's like a delay. Like there's none, and then like they flood in with a lot of people, which I like.
Yeah.
Cool. Mary, Barb, Christian, Mike. Cool. Nice to speak with you. So, real quick on the history between Steve Smith and I. This goes back a long time ago, over 10 years ago.
10 years now. Yep.
Where my company had been transitioning very much into options, and it was just getting more and more popular, and I needed to find new people. And I did like a deep dive online of just reading all these different options personalities and stuff, and I found myself reading a lot of Steve Smith's options articles. He had written for both The Street when James Kramer was there, and Minionville with Todd Harrison, a guy I played basketball with. And he had done a lot of great work. And he also had worked for a hedge fund and helped them to hedge on like a multi-billion-dollar portfolio.
Yeah.
So a lot of experience. And, you know, I always say there's different threats. Being able to trade is one threat. Being able to write about trading is another. So it makes him a dual threat. So I reached out probably like 2 or 3 in the morning, because at that time, if I went on a bender, I just was up all night reading stuff. And then we connected the next day, got started right away. I remember, what was the very first trade? Was it AMD? I don't remember, but
it was UNH. I remember because you remembered it like 2 years later when we traded UNH. We said UNH, that was our very first trade.
Yeah, UNH, you're right. UNH, very first trade.
And then what's also funny, because we'll get to it as part of is earnings is going on now. And this is options 360. So this is not earnings trades, but like my third trade was an earnings trade. And you were like, what? We just signed up. It's like, we're going to look, you know, because earnings can be, you know, hit or miss. And you were I think we ended up making money, but
I was very nervous about earnings trades. That's for sure.
So now that I've been doing that 8 years or 7 years, we've realized we can make money doing that without being incredibly risky, you know, throwing darts at it. But that's for a different time and place. We're going to talk about options 360 today.
For sure, though, on the earnings trades. And so we got started, and we've worked together ever since. And it was our company, and then we sold it to Tiffin. Then we got it back, still together. So you go where I go, which is nice.
Yeah. And I love working with you. Love the whole team. There's, you know, just the mesh team has always been good. Most of the people there have been with you for longer than me even.
Yeah, that's awesome. And you know, you're a very consistent professional trader, and you've put together some really good services at really good prices. People stuck with you for a long time. So I'm excited for you to introduce them to Options 360. By the way, when you were at the Street, did you ever connect with James Kramer, or you had like someone else you worked with, or?
Yeah, no, but it was, I wasn't really a coworker, but we were on a first name basis and would see him. And one of my first encounters with him within the first year was I would get to the office early, and he was like a little before 7, And he gets into the elevator with me, and he was all revved. He's like, "Did you hear?" Well, I'm thinking like Pfizer, because they report. It's like, "Did you hear the Pfizer conference call?" And I'm like, "Whoa, dude, it's like 6:45 in the morning. Take it easy on me." Yeah. So he is who he is. He is what he presents.
All right. Well, let's what we're going to do today. So the difference, by the way, we mentioned two different things. One is an earning service where Steve just puts on trades during earnings, and the other is Options 360, which is the best kind of option trade all year round, where he'll write about it. He'll put the trades on. You could track them in a portfolio. There is a win-loss record, a track record. Very successful over the years. I'm sure we'll get into that. But Steve, I kind of took a page out of your book with what I did with Mesh Prime, where I said I no longer want to just have like credit spreads or diagonals or calls. Yeah. I just want to have one strategy, whatever I think is the best strategy at the time. Yeah. And it's been a lot better. And so what do you think the benefit is of not aligning yourself to a specific strategy versus just being able to adjust with the market, and what would you say are some of the
I think for first of all, it depends on your style of trading. So I mean, there's some option traders, right, from my market maker experience, who are strictly going to be like edge traders or volatility traders, like people probably familiar with Tom Sosnoff. So I mean, he's going to scan his opportunities looking for what's trading at the at a high percentage of its volatility and what's going to give him a probability. And he's strictly on that. He almost doesn't care at all about like the direction of the stock or what the trend has been, or the technicals. I think you and I are a little bit more directional. So, that would be, it's really the last thing is like you can align your strategy with your trade thesis. So it's going to give you more opportunities. So for in a low volatility market, maybe you do, which we both use a lot of, is diagonal spreads that allow you to capture, a directional move, but maybe it's not explosive. And while you're waiting for a move to develop, you're collecting income, you're collecting premium and reducing your cost basis. So I think the main thing of not being constrained by is more opportunity, and to really then try and maximize what your profit is. So if if you're trading a high beta name and you think the setup is, it's a bull flag, and you say, it could really explode out of here, then you want something that's going to benefit from a more explosive move. So maybe you're not going to sell a credit spread. Maybe, even as a trade that we put on recently, I'll show you, that's like a risk reversal that can really, kind of a low cost basis, limited risk, but gives you a lot of upside if there's really an explosive move. So in a way that kind of covers this slide. So why don't we start just talking about how, drilling down a little bit into it. So I use, kind of just labeled it a 3P approach for process, profit, and the probability. And you kind of under those different themes, you want to use options that, give the benefit of options are it's limited risk and it can give you leverage. So you have the power for good profit potential. And I really kind of keep it pretty basic, right? Vertical spreads, a lot of diagonal spreads, credit spreads, occasional iron condor. Big rule, nothing naked. I learned my lesson the hard way when, like I said, I was pretty young. I was 23 when I first went on the Chicago Board of Options Exchange. And I sold some naked a couple times and really got hammered. And it took me a couple times to learn my lesson. Now there's always a defined risk. And also it just makes sense, even if you're doing credit spreads, it's better for margining, right? You sell something naked, it chews up a lot of margin. And the flip side of that is I don't do lottery tickets. I'm not just going to buy way out of the money call. Those are exciting. You'll see the returns that I get, those can be exciting, the 300% return, but that's not, my game is consistency, acknowledging there's going to be losses. So my target is to have something like a 65% win rate, that the profits are somewhere, that may be a little aggressive, 60 to 90%, but it's doable, and then keep the losses to 25 to 50% on the downside. So you do that, and you can end up, over the course of a year, having a return that's in 50 to 80% if you achieve those kind of numbers. All right. So the process is price takes precedence, and that really basically means that I start with the chart. So I'll have a watch list. Maybe there's 50 that are active, and some rotate in and out. Depends on what's going on. Like recently, we've seen some of the sectors come into play, whether it's robotics and drone satellites, or certainly anything related to AI, especially the energy area of it, such as nuclear. So I'll, have my watch list and try and look for some setups that I think are quality setups that are like, this is a good entry. That's my target. Where would I take a stop loss? So I'll have kind of defined parameters. I'll also do some fundamental research just to really understand, I'm not going to dive too deep into the balance sheet. I'm really a relatively shorter term trader. So the fundamentals aren't huge, but what I do like is to just get an idea of like, what's the narrative around the stock? And so, where's my kind of, what are the catalysts? And then also like, what are the events or risks that are surrounding it? Just to kind of have the story and understand, a little bit of valuation that's, especially like I said, come into earnings or there's an announcement, can there just be a big hole in the price? Can you see a big gap? So just helps you understand the risk. Then you move on to, options analysis. What are the volatility levels and where does that fit in terms of how a stock trades historically? Is the implied way above what it normally is, and how is it relative to the realized volatility, right? But I'm not going to be so honed again towards just identifying trades based on the option pricing. We want liquid names and just have an idea of like, where is it in terms of its 52-week pricing behavior. And then that's when it comes to like identifying the strategy that best aligns with it. Do I want to have a credit spread because I think the stock basically, I don't, and you'll see there's a trade we made in Apple like 2 weeks ago, whereas like, I don't think there's that much more downside, but I don't know what the upside may be. So maybe I sell a bull put credit spread instead of a debit spread on something like that. Or what I'll show you in ASTS, it's a satellite company that we did something that can benefit from an explosive move. It's more of a momentum kind of play. So, and really the go-to strategy is usually diagonals, though recently been doing a little bit more of other things, which I'll show you. All right, so then there's the probability and profitability. Again, looking for about a 60-40 win-loss ratio. So we've talked about this. And then, so if you achieve those numbers, you can, I don't know if that's the right language. I meant to say easily stumble, as you can easily achieve, you can get a 50 to 80% return. So, and you can see this is about where I've been, typically make about 70 or 80 trades a year. I reset the portfolio every year to $10,000. So that's another thing is I like to, I want this to be accessible to smaller accounts, and you can really probably do this with $5,000 accounts. So I'll read through, the years. Basically, the average return over these 10 years is, let's call it 50%. And went off the last couple of years a little bit, at the lower end of the first couple of years. Some of that is, the nature of the market. I think got, between pandemic, bear market, and I don't know why I found 23 a little difficult. I guess we were still trying to figure out, like, are we in the bear market, and things were kind of coming out of left field. Excuse me. But anyway, back to the account size.
By the way, Steve, I just want to take a moment because you should be really proud of that. I mean, even like, you're talking about 23, still. I mean, this is why you do what you do, and this is what people should pay attention to. That as a options trader, and that's what I meant by professional trader. You're making double-digit percentage returns year over year in a comfortable way. Not a lot of headaches.
No.
Not a lot of roller coasters. And I think this is what people really want to learn and we feel good about. And let me ask you, am I right? Is that you guys would be pretty happy with this, right? Give me a yes if you'd be happy with this, because you should. I don't want to just gloss over it because most people won't be able to show a slide like this if they're presenting, and you should be really proud of it. So I just didn't want to gloss over
Thank
it.
you.
You've done a
Yeah,
great
no,
job.
so
That's
then the last, yeah, then the last point on, resetting the portfolio is again to, that helps also is like part of, I think the service is showing like what kind of allocations would I make if I had a $10,000 portfolio. And you could really do, and just to give you an idea of, and this is also this service, you don't have to sit in front of your screen. Send out an alert. You can trade from your phone, and typically it is like 2 or 3 trades a week. Let's call it 2 new trades a week, and then maybe you have like 2 adjustments. So that may be like 4 or 5 alerts a week. So it's low maintenance in that sense. So you don't have to be sitting in front of your screen watching every tick and everything. And then in terms of like what we allocate, each trade, if it's $10,000 portfolio, I'm only allocating maybe 3% to any one position, and I'll only have like 4 or 5 positions at a time. So realistically, I use like a third of, at any given time, a third of the account, which means you could do it with like a $5,000 account. On the other hand, if you have a larger account and you're comfortable with me, you can scale up. And that's one of the reasons I want to, have a small, I think it's a lot easier for people to scale up and increase their risk if they want, as it's appropriate to their portfolio size, than intimidate people and say, I have $100,000 or $1 million, portfolio just to put up big numbers. So you'll see a lot of our trades are 1 or 2 contracts. We're making $200 or $300. Same, and the losses are also in the $100 to $300 range. So it's manageable. Like Adam said, this isn't about, having a roller coaster. All right, so let's look at a couple of trades. These are from a while ago, and they may be a little bit more difficult to read, but I wanted to just show them to give you concept of how I approached that whole 3P kind of thing. So it's a little difficult to read, even me with my glasses on, but the gist of it is here's a Visa chart, right? So it had formed this kind of nice rounding bottom, you call it a cup or a saucer. And I said, let's put on a bullish diagonal. And for those, unfamiliar with it, that simply means you're buying a call with a later expiration date and then selling a further out of the money call with a closer expiration date. And the way I structure these, so this is a $5 wide spread, right? We're buying the 207.50, selling the 212.50, and we're paying 235. So that's typically how you want to set these up, is you want to pay less than the width between the strikes. So that way, if it goes up and through the strike, you still have a profit. If it hovers between them, this one, actually, I only separated it by a week because I felt like this was about to move up and out of that pattern. So we actually, I'm not sure where the stock was trading at this point. We probably did something that was only at the money instead of, in the money. So I don't want to, beat on this one, but the stock did move up and out. We didn't have to take any rolls. We'll get to that next. And we had a 41% return on our risk. And that's a big thing when we get to credit spreads, that you measure your return on risk. Okay. So that was just an example of using a diagonal without drill, that it keyed off of the chart, chose the strikes that seemed to make sense, that aligned with my outlook that the stock was coming out of this saucer or cup and was about to push higher. Here's a bullish diagonal in Morgan Stanley, where we're going to look at the power of rolling. So we initiated this trade in the first week of June. We paid $1.30 for the initial diagonal. Right, we ended up executing with this when the shares were between 43 and 56 over the next 30 days, where we executed 3 rolls during that time. So each time we collected premium, and we got our cost basis down to just 35 cents in the first week of July. So a month later, we were able to exit the position for $1.50 or 75% return over the 35-day holding period. And here's a breakdown of what I mean by you can get like with the diagonals, a directional move, and then also income generation. Like Adam, you like to compare it to being a landlord, right? You own the building, maybe that appreciates in price, and in the meantime, you're renting out office space or whatever it may be, or it's a house that you own. So we own the long dated, right? So we bought the 4250 call that expired in July 14th, and then we rolled it three times and collected those premiums. So the way I looked at it was 44% of our profit was derived from a directional move, and 66% of the profit was actually derived from income collection, premium collection. So that's kind of breaking it down because we use these quite a bit. So just kind of understand.
And by the way, that $445 or 75% return is on probably it's on like $600 risk.
Let me see. I don't know how many contracts we did initially, but we paid $1
because 75% of 600 would be around 445. So it's around.
Okay, you see the total. I got you.
So it's not, so if it was $6,000, that would be 4,450. Because a lot of times people get caught up with the numbers, and we know people in this industry will like to put really big numbers.
Yes.
And
or they like to mix and match percentage and dollar. They'll trade something that's incredibly cheap and say I had, I had a 8,000% return, and what that turned into is $20.
I think people love this kind of trade. We could risk $600, make 445. It's great.
Okay. Oh, all right, let's see what we do next. So here's just a different way, and then we'll get to some slides that are easier to read that are recent trades. This is a McDonald's, and we did a bear call spread. So the trade actually started over on the right. So I was looking at that and said, hey, here's kind of a head and shoulders. I'm not sure how much downside there is, but I think at this point we could sell a call spread that's above that old high and have a high probability that it's not going to get back up there. So we sold it based that we can't see the order ticket on the right is cut off, but again, as Adam says, if we closed it we ended up closing it for a nickel 2 weeks later. So we initiated at 11/30, November 30th. We closed it December 15th. We bought it back for a nickel, which means we probably sold this for about 80 cents because the way you measure that risk on return, right? We sold a $5 wide spread. We collected 80 cents, which means we had $4.20 of risk. So this may seem like, what's the big deal? 14% return, but it's a super high probability trade. And to make 14% in 2 weeks is pretty good. So this is also part of having, using various styles of trade, that this is a way to kind of smooth out your returns and get to that 50% without always having to hit home runs. It's like, you kind of sprinkle in these very high probability credit spreads into the mix. All right, I think now we'll get to some more recent trades. And so this was January 13th, so it should be a little easier to read too. So this is taken from the alert. This is like the alert you'll see now, because the format changed. We've prioritized getting the alerts out quickly rather than being able to have a lot of content and write, sometimes I would go crazy. Like Adam said, sometimes he likes that I write, but sometimes in an alert, people are like, I don't need to read all that. Just give me the trade. So we kind of found a balance here. So it sent out the alert and said the SPY had, you can see here on the chart, it filled that election day gap, right? After gapping higher back here in November, early November, hit new highs, filled the gap. It said this looks like a good spot where we might get a bounce. Kept it very small, probably had some other bullish positions on, but just try and grab some. So this is in the SPY. We bought one contract of the 117.580 call, and we sold one of the 114.582 calls, paid 285. This is where you can use some of the daily options, what people refer to as zero data expiration, where you can basically make a really small, like a weekly diagonal, where you can buy something a week out and then roll it if you want every day. So I've been doing that. But again, if it moves up in 3-year strike quickly, you can take a profit. So we ended up taking one roll. We got a nice bounce. This is the way the alert came out. Let's roll the SPY to collect premium and reduce cost basis. So what we did was we rolled the short leg, rolled the 582 right from just one day, 114 to 115, and we collected $1.80. So now our new cost basis is just 85 cents on a $2 wide spread. The very next day, SPY just continued to push higher, blasted through our strikes, book a solid profit, 98% return in a 3-day holding period. So we closed it out for 270 credit. Again, small one contract. You're happy to do more. I said the other positions we had were probably already leaning bullish as we had sold off. So didn't want to take on too much risk there, but just added, another arrow in our quiver there, part of looking a little holistically at what your holdings are rather than each trade in total isolation. Every trade has to stand on its own, but you do want to be a little bit aware of, what you're looking at in terms of your other holdings. Here was a trade on January 21st, Apple bull put spread. Apple just, after going basically vertically up, came straight down and hit what I said, looked like a good support level, and felt like there wouldn't be that much more downside ahead of its earnings. So we went right at the money, sold the 220 put, covered it by buying the 215 put. We collected $1.40, and I believe we covered it for like 20 cents. Apple exit. It was only like 2 days later, right? We did this on the 21st. Apple did get a bounce. Since we were right at the money and we went relatively short term, we were able to just cover it for 20 cents, which if you translate that into, you can look at it as it's 91% of the max profit or 45% return on the risk. All right, so we were risking 220. We did 2 contracts. We were risking 260, and we earned 220. Okay. Let's see. Here's something, and then I think that'll be kind of the last of the trades. But I wanted to show this one because it's a little bit different. ASTS. So I'll write a little bit about it. That's a satellite company. Had really caught people's attention. Kind of trailed off. So I said, let's use a modified risk reversal, which involves selling a credit put spread to finance the purchase of a call outright. So what we did was we sold the 1917 put spread, and we used that to finance the purchase of a $23 call, and it cost us $10 per contract. All right. So, and our risk is defined by if it went down below 17 at expiration, we have a limited risk of $200 for the one contract trade, and we have unlimited upside. You can see it's threatened down there, but because we had that defined risk and still had time left, we've held on. And actually, I'm not sure if I can show the stock is now. Let me see if I do this properly. I don't.
Love this stock. This is a find last year.
Share screen. Let me see. Share screen.
ASTS. They have. They're going to provide the satellites for Verizon and.
Yes. So that was a catalyst a couple days ago. So now you can see the stock is coming back towards our. So now we just have unlimited. So after looking like it was trouble, but because we had a defined risk, said we can hold on to this. We still have time. Let's see if it catches a bid, because this could be a momentum stock. You see what it did when it first caught people's attention. So, there's no reason it can't. I think if we get a close above 23, you could see 25, 26 very quickly, and that would turn this into, a nice winner. All right, let me make sure I can stop sharing and go back here. Are you guys seeing the slides again, or let me make sure.
Yeah, we're seeing them.
You seeing the
I see
slides?
ASTS still open.
Yes. Okay. All right. So now that's still open. Here we'll just go through some recent trades, and maybe we can just talk about what I think, because some of them are still open. So we had a bearish trade in the SPY. It was just a 2-day holding period. This was Okta, not Aka, cybersecurity stock. That one we ended up we went through multiple adjustments, gave me a little trouble. DocuSign, 21-day holding period at a 25% loss. McDonald's bear, a gain. I'm not sure if that one was a credit or not. We're still, no, we just closed SMR. That was a nice win. 52% gain in 16 days. Netflix Iron Condor. We were up, and today we just closed it because the stock threatened our upside. Our call strike was 1,005, and it traded 1,008 today. Thankfully, we did have, we got some time decay. And also, one of the reasons I did this was I did it like 2 days after earnings. So implied volatility was still fairly pumped up. We could actually, let's see if I can look at the chart, make ourselves a little, the same thing happened with share screen. Share screen, go back to the live chart. So you can see Netflix, it kind of shook me out today here. You see, I had these lines beforehand, and we put it on, I think 1 or 2 days after the earnings when implied volatility was still kind of high. And our inside strikes were 940 and 1005. We actually closed half yesterday for a decent profit. I think we sold the whole thing for 240, covered half at 140, and today we ended up closing the other half at 2, which turns out was premature. But I didn't want to watch. One of the things about credit spreads, I didn't want to watch this. In the morning when it's going up here, you're saying, okay, it's taking out the earnings high, and this looks like, okay, this meant that this was a bullish flag. It was consolidating and ready for a new leg up. So it seemed prudent to just lock in the gain rather than try and ride this until Friday's expiration and then watch our profit vanish. And that's one thing about credit spreads, is you definitely don't want to overstay your welcome. Again, I'll refer to Tom. He has his windows where, sell something 45 days, he closes it at 20 days. So he's very mechanical that way. I tend to do credit spreads a little bit shorter time frame, but I'll also rarely ever ride it out until the final day. And then while we have the chart up, we also did a bear spread in Meta, which is now threatening us. We closed half, but this was also after the earnings report, and saw this, saw it kind of reverse, said, okay, we can sell something above it, sell the 715, and there's a probability that, that it expires this Friday, that it's not going to get back up there. So right now, have to keep an eye on it, but so far it's okay, it's working. Stop sharing. Well, that's big face. And just to remind you, okay, there's the returns. We don't need to hash that out again because I don't want to take up too much time. Here's kind of what you get with the service, right? So the alerts come out when I see a trade. I will usually not send something out much less than, with an hour to go. Usually, I'm not going to send something out within the last 15 minutes. And usually most trades, unless it's a quick adjustment or quick profit, not going to send something out within the first 10, 15 minutes. Let the option prices set up, or let the price action kind of set up. So you get a Monday outlook. That's become shorter just because of the new and a position recap. I guess it's usually 2 to 4 trades a week, with definitely 1 or 2 of those being new trades, and then you might have adjustments. The alerts try to spell out exactly what you need to do with the entry, limit prices for your entry prices, so you can take your time. It's not live trading where you'd be like, I have to do this and do it right now. Sometimes I say the stock may need to move here for us to get filled at this price, so you can leave the limit order in. You have access to the real-time portfolio, and I do live calls twice a month, and may do something. Let me talk to you, Adam, about increasing that and doing something where it's even just 15, 30 minutes, 1 or 2 times a week, just because now that the alerts don't include charts and so much verbiage, just to make sure that people are getting what my thoughts are and going through the market in the open position. So maybe we'll add a little bit more of live, webinar type calls. All right, this is you, Adam. The great offers that we're having here to get with this program.
I mean, yeah, I think there's 2 prices. It's $199 for 3 months, or $599 for a year. So let me do the math. So this option would save you $200. But either one, if you go to adameshlive.com/0360 yearly, let me just make sure you can click on that. That's a little hard, a little bit of a difficult link. There's like a dash and stuff. I don't know how people would type that in. I couldn't type that in. So if I want to click on that link, Patrick, how do I?
He's in the chat box. I think you could just click on it directly in the chat box.
I can't.
Oh.
Patrick, can you make it so we could click on that link? I don't know. Are you guys able to click on this link to go to it to take advantage of that steal of a price? Let me know if you could click on the link. I can't. When I click on the box, I don't know. Yeah, it won't let you. It won't let me either.
Yeah, I see.
See, that's not a good link. Let me just go type it, make sure it works.
And Christian, real quick, as far as SMR, you're correct. You know what? We ended up rolling it, so we're still in that.
So adameshlive.com/0360, and then it's a dash yearly. If you want the yearly, that does come up. And then go back to the other one. Let me just see the other one. Everyone's saying it works.
Yes.
So the link works for everyone except for me and Patrick. Okay.
And me. It might be.
Okay. So the link works for you guys. So the month, that's for 3 months. If you want to try it for less, I guess either price is good. That's adameshlive.com/0360. And I mean, if you
do get with the yearly, you get a quarter of the earnings, 360.
So we haven't even gotten into that. And we don't even need to get into it yet, but I will one sec. So you saw since 2015, the portfolio has been up every year for the last 10 years. It's a decade of proven success. So that's not a fluke. The worst year, which he was almost apologizing about, was up 27%. Now, then the question becomes a matter of size. Can you do this for the recommended size, $500 around per trade? And would you be happy with that? Probably. You'd be thrilled at this price. If you start to scale up, and I'm sure there's people that have been on with you, Steve, that are doing bigger size. I know there's people with me that do bigger size over a decade, then that just becomes more. So, if in your worst year, if you were trading with $10,000, you made $2,700. If you were trading with $100,000, you made $27,000. And this is for $599 a year, or $199 for 3 months. So really a no-brainer pricing. Now add on to that, you get his earnings 360 service free for 3 months, which is another $250 value. And just as an idea, without even spending a lot of time on how good that is, Steve, I know I asked you already, so I won't pretend like I didn't ask you. But you guys made money on Palantir, had earnings last night.
Yes.
What'd you do in Palantir?
All the earnings are spreads. So this time we actually did a diagonal just because I was worried there might be a sell the news, but it was a bullish spread. We went a little out of the money, so that way we could, if there was a big move, they were pricing in a 20% move. But I wanted to give ourselves the time using the diagonal in case there was an initial sell the news. We would still have another week. Anyway, we obviously blew right in, put the spread totally in the money, and we earned about 75% return. And so these trades are usually overnight trades. I've been doing that for about 25 quarters or seasons. And I think we've had 3 losing quarters out of those 25, and they've been less than $500 losses. So it's also been.
So I really hope everyone goes and takes advantage of this offer. The pricing is like 1970s pricing for this kind of service. So Steve loves what he does. And it's really just a no-brainer that I hope if you like options trading that you do it.
So and I'll just kind of reiterate in terms of the scaling up, like the trades I just showed you that were in this past month. You see there was 1 contract, 2 contracts. That SPY trade we spent $150, those kinds of things, and doubled our money. So that's real easy for. I just tend to be conservative. I want to be a proselytizer for options, and I know there's new people or some people who have a smaller account, and I don't want them to walk into option. You want to do options the right way, and it's just so much easier to have people in their comfort level, and then have people intimidated, and then they say, you know what, this isn't for me. I can't afford that kind of risk. I don't, so.
Greg said, I've been with Steve for approximately 2 years. I didn't know they were the worst 2 till now, but I'm very pleased with my returns to date. His knowledge, integrity is a value you won't see in other services that has brought my trading for the first time to a comfortable and profitable place. I can't wait now knowing that it's only going to get better. Thanks again, Steve. And Patrick, please save that. That's a great comment by Greg live on this call. So thanks, Greg. I appreciate it.
I do too. Thank you very much.
If anybody also just has some questions, like we are a very niche, we've set ourselves up where we could very much cater to the individuals. I don't have a list for how many people are on this call. I saw the ones that chatted in at the beginning. If anyone wants, Patrick, does everyone see everyone's comments? Like, can everyone see Greg's comments on here or no? Yes. Oh, you could. Okay. So then don't put your phone numbers in here because then everyone will see it. That's why I asked that. But Josh, if you wanna throw in your number for anyone that has questions that they could call, I like everyone to know that we'll cater to them specifically. It's important for me. Yeah, Steve, you built up a service, a track record of success. I think people are in good hands, and I hope that we keep just bringing you great people into your community to keep that service humming along. I really do.
Yeah, because I love doing this. Like I said, I'm a proselytizer for, some people, I'll be honest, like I said, I'm very transparent and honest about it. And people, if something's not appropriate, I say, don't do it. And, I just want people to know that they can take their own financial, be self-directed and then do it the right way without being sold a bill of goods about, outlandish things that aren't realistic.
Right. Josh, there's Josh's number. If anyone has any questions, his email, any questions on anything in terms of, there we go. What type of options and how many trades? So it's diagonals, it's credit spreads. And then do you know how many trades you made total last year, Steve? Around?
I think that's what we run about 65 to 70 trades per year. And then, as far as the number of alerts, there's going to be more because, like I said, we lean heavily on diagonals. So there's the adjustments. But individual trades, like a position, individual positions, somewhere, let's call it 60 to 70.
Customer service has always been top too. Thanks, guys. Love Greg. You got to get back into hats and shirts and stuff to give away, Steve. I like these comments.
Yeah.
Now this is fun. I think you do a great job. I think the service speaks for itself. I think the numbers speak for itself. And I think that for people that want to make professional option trades, this is the absolute best way to do it. But for real, any other questions while we're here is good. That's what this forum's for. Like, we kind of invented this way. I don't know if you know the origin of webinars, but let me give everybody real quick the origin of webinar story. Steve, I don't even know if I've ever told you this, but I'll tell you now. So back in the day, I'm gonna make myself a little louder now. Back in the day, when I got into this industry around 2011, so I've been doing it for like 5 years. It was like 14 years ago. I don't like not being able to see the total number of people in here, but just write yes if you want to hear the story right now, because it's a good story. Just write yes. Let me see the yes in the chats. I like to know I have an audience. That's the only thing I don't like about this StreamYard. I gotta speak to JJ or Patch. We gotta figure out how I could see the attendance. Okay, thank you. So in 2011, Stansberry, before they got sold and became like MarketWise or whatever, they came out with a promotion called End of America. And it was an hour video that talked about why America is going to come to an end. And they sold like probably over 100,000 $50 subscriptions. It was just the most ridiculous campaign. And then Newsmax came out. They made a movie which was called Aftershock. And it was like a $500,000 feature film, again, to sell a $50 subscription. And I wasn't someone that was like had investors or anything like that. It was just my company. And I'm like, I'm not spending $500,000 on a movie to sell a $50 front end service. I'm like, this is crazy. I'm like, what I'm going to do is I'm going to go out and show people exactly what kind of trades we're going to make with real life examples and a track record, and answer any questions they have, so that when they join, they know exactly what they're getting. They didn't watch a movie to buy something for $50. And then the benefit of that is going to be that once they're in, they won't leave because they knew exactly what they were getting. And I started doing that. And after that, love me or hate me, that's when webinars became such a big thing in our industry. Everyone else started doing it too. But for me, it was just not wanting to spend $500,000 on a movie to sell trading ideas. Anyhow, so here we are all these years later. There's new and innovative ways of doing things, but I love the idea of just coming on a webinar, showing people, here's my track record, here's my strategies, here's exactly what you're going to get, and here's a fair price. So I hope you guys like that too, and I hope you join at the links. Patrick, if you could just chat out the links one more time. Chris, there is education around the trades, and Steve does a great job of going over the setup, which is important. Laura, I am feeling better. Yes, thank you. Yeah, and the price, because it's $199 for 3 months, never goes up, or $599 for the year. If you want to try it for 3 months, it's $199, and then I guess honestly, what you guys could do is this. I'll tell you what you could do, and we'll be cool about this. Do the $199. Go to the other link, the quarterly. They should just do the quarterly, and then you're gonna love it. As long as you update, and you could upgrade in the first 30 days once you make sure you love it to the $599 for the year, and you'll save $200. So I'll give you the best of both worlds. Come in through the $199. And then you could still take the $599 price. I'll give you 40 days, because 30 doesn't seem like enough. 40 days to to upgrade for the year if you want. So you could still save that $200. So you could get in right now for $199. And then as long as you upgrade within 40 days, you'll save 200 and it'll be great. And I think you'll love it. Okay. Does that sound good? And Patrick will make a note of that. All right. So everyone take advantage now.
Sounds good. Just you had me thinking when you're talking about the beginning of webinars. So I first started having an option newsletter in 2000 at thestreet.com, and it was basically email. And the latency by the time I sent it in, somebody edited, and then it got sent out. It was like almost an hour. So it was a different rhythm, and I felt like that was great compared to people used to send out newsletters, right, in print. So we were like, wow, people would be waiting 2 days for this information. We're getting out at an hour. And now, like, that was one of the appeals of joining you, was I was still doing with Minionville those kind of email based, and then to have live webinars, have text alerts, just like you said, the evolution of all these things. So
awesome. Greg said I researched you before signing up, and that's one thing they kept saying was the innovation by you. Thank you. I appreciate that. All right. We appreciate you guys so much. Steve, thank you.
Thank you. Thank you, everybody who attended. Appreciate your time.
Yeah, I really appreciate you so much. You did a great job. Greg, thanks for all the comments. Everyone else, thanks for participating. If you have any questions, you could call Josh. You can email him. He put his phone number in there. You could go to the link. And away we go. All right, everyone. Thank you.
Everybody have a great day. Thanks, Adam.
Bye.